Welcome, future homeowners. Many of us dream of owning a place to call our own, but navigating the path to homeownership can feel daunting. Today, we'll deconstruct the concept of bare minimum, revealing why exceeding these basic requirements unlocks significant advantages. Think of this as your strategic roadmap to unlocking your dream home. I'm Bogdan Todoret, your bearded loan guy, and I hope to be your bearded loan guide to homeownership. Hopefully, that's why you're here. So let's start with credit. Your credit score is the cornerstone of your financial profile, influencing your loan options, interest rates, and even private mortgage insurance. While the minimum qualifying score for a conventional loan is 620 and 580 is the minimum for an FHA loan, it's crucial to understand that the lower score can pose some drawbacks. Don't get me wrong, it gets your foot in the door, but they also mean higher interest rates. Moreover, a low credit score goes beyond the mortgage loan to impact other things like your homeowner's insurance premium. Scores in the 740 plus range, or if you go for the extra credit 780 plus, will unlock significantly lower interest rates, saving you thousands over the loan term. That's the equivalent of finding a hidden discount on your dream home. So how can you strategically boost your credit score? First, you have to maintain consistent on-time bill payments. This demonstrates responsible financial habits. Next, you should utilize credit responsibly, avoiding maxing out cards. Here, the aim is for a utilization rate below 30%. Dispute any errors on your credit report promptly because this ensures accuracy and maximizes your score, but make sure those disputes are resolved before applying for a mortgage loan. Consider a secured credit card for credit building and use it responsibly. Lastly, never close an account. You can pay it off, but do not close it. Closing an account that provided a good credit history can in fact lower your scores. Now, people in my industry tend to not like Credit Karma because of inaccuracy, but it's actually a great tool to track credit. They just use a different credit score model than what a mortgage company uses. That's why the credit score may seem inaccurate at times, so use it as a tracking tool, but keep in mind that the credit score can be different than the one a mortgage company will pull. Now let's talk about income and DTI. While income is important, your debt-to-income ratio, DTI, paints a more complete picture. The maximum acceptable DTI is technically 50% for conventional and 57% for FHA. But when you look at the specifics of your loan and your situation, it may be more restrictive. But here's the truth. A high DTI can put a strain on your finances. Keeping your DTI below 43% puts you in a better financial position with potentially better terms and lower rates. But the main thing is, and I'll be frank here, you won't be house poor. How can you strategically manage your DTI? First, you can explore avenues to increase your income. Consider career advancement or accreditations that can increase your pay, negotiation opportunities, or side hustles. Again, keep in mind that you will need to show a 2-year history of working 2 jobs at the same time in order to consider the side hustle or second job income along with your primary income. Prioritize paying down high interest debt. Focus on loans with the highest interest rates first. And pro tip here, if you get within 10 payments or less, you don't actually have to pay it off. The lender will disregard that monthly payment from your DTI. Collaborate with a qualified cosigner if needed. You will then share the responsibility and improve your loan eligibility. Research and leverage government programs you may qualify for. They can offer valuable assistance, and a good local loan officer should have a good handle on the options available in your area. Let's move on to down payment. The down payment is your initial investment in your dream home. While the minimum is 3% for conventional and 3.5% for FHA, consider this. Putting down 20% eliminates private mortgage insurance, or PMI, for the conventional loan, saving you thousands of dollars over the loan term. Imagine it as skipping in line or unlocking immediate savings. It also gets you a lower interest rate most of the time. But a good lender can get creative by combining upfront mortgage insurance, for example, with a 10% or 15% down payment, lowering the monthly mortgage insurance. This, in effect, keeps money in your pocket for things like furniture or improvements. Then, how can you strategically increase your down payment? Well, one, you can set up automatic transfers to dedicated savings accounts. You basically make saving a consistent habit. And these days, high yield savings accounts offer considerable yields. Implement a saving challenge, aim for 5 or even 10% of your income dedicated to your down payment. You could also explore creative income streams, even though it may not be used towards your qualifying income. You can sell unused items, utilize freelance skills, or consider temporary side hustles. But keep in mind, the large deposits will need to be explained and documented. A large deposit for conventional is 50% of your monthly income, and for FHA is 1% of your loan amount. That's why it's always important to have a good loan officer to guide you through these steps. Lastly, invest strategically for short-term growth. Consider options like 12-month CDs if your timeline allows. Remember, the bare minimum gets you in the door, but going beyond unlocks significant benefits. Lower interest rates equal more money for homeownership expenses and enjoyment. Stronger credit score equals better deals on loans and insurance. Larger down payment equals no PMI, saving you money every month. Healthy DTI equals less strain on your finances down the road. And homeownership is a rewarding journey, and preparation is your best asset. By understanding the bare minimum and strategizing to exceed it, you'll navigate the process with confidence and unlock even greater rewards down the line. Remember, owning your dream home is achievable with the right guidance and planning. Stay tuned for future videos where we'll delve deeper into specific strategies and resources to help you make your dream a reality. If you reach this point, like this video, share, and subscribe. Until next week, your bearded loan guy out.